Hi, my name is Doug Goldstein. I'm the Director of Profile Investment Services. I'm a certified financial planner and an international investment advisor. Today I'd like to talk to you about a topic that comes up with clients a great deal, which is how to retire early. Many people want to plan on retiring early, and they save for it and they prepare for it. So let's talk today about some of the things that they can do. So the first thing is to understand the issues that can really ruin a retirement. So today we'll be talking about inflation. We're going to be talking about spending, because not only do you have to earn the money from your investments or from your pensions, but you have to spend the right amount of money. We're going to talk about how important it is to remain flexible, that when you retire early, this is a long-term decision and you have to go with the flow, because there will surely be a lot of changes along the ways. And finally, we'll talk about the traditional ways that people handle their portfolio. So those are our topics today, and let me invite you that as a result of this conversation, if you have any further questions, get in touch with me. You can go to our website at profile-financial.com. Here we go. The first problem that people have is dealing with inflation. So if you are considering retiring early, then you're probably old enough to remember at least some period in time when there was high inflation. And basically what happens when there's inflation is that the money that you expect to be able to use to buy something no longer buys that thing. So for example, if it cost you $100 to fill up your basket at the grocery store today, if inflation's 3%, you will be able to buy exactly the same things next year, but it will cost you $103. And obviously, if this goes on for many years, and if you've retired, by the way, this doesn't apply to only early retirees, but it also retires to anyone who, it applies to anyone who retires. And the fact is that over time, over the decades in your retirement, the things that you expected to cost a certain amount will end up costing more. If you buy regular bonds, bonds have a fixed interest that they pay, and they pay you back a fixed amount at maturity. It's certainly a good tool for retirees, but you might also want to begin to investigate inflation-linked bonds. The benefit of having an inflation-linked bond is that over time, the principal value of the bond will increase in line with inflation. Now, it's not perfect. None of these things that we are going to discuss today are perfect solutions, but at least it gives you a little bit of protection. The other thing you might want to consider about is a strategy that you can use with Social Security, or if you're living outside the United States and you are entitled to a government pension from another government. Normally, the longer you wait to collect the pension, meaning if you wait until, let's say, you're 70 instead of starting to collect at 67 or 65 or 62, if you wait longer, they'll give you a greater amount every month. If you live the statistically average age, it won't matter. However, if you are able to afford your monthly expenses until you're 70, and especially if you think you are going to live a good long life, then you'll benefit a lot, because you will get a higher monthly payment for a longer number of years, and that can certainly help to improve cash flow. The other thing you need to remember is that if you retire at any point and expect to be living for 5, 10, 15, 20, 30, 40, 50 years or more, you need to have a portion of your portfolio that's actually going to grow. So there's nothing wrong with having some percentage of your account in growth stocks, in the stock market itself. Now, obviously, there are risks to that, and it's not meant for everyone, but be sure to sit with a financial planner to work out an asset allocation model. And if in that asset allocation model, which is really just a pie chart of what percentage of your money should be in this investment or that investment, if some of the pie chart shows that you should have money in stocks, be sure to do that in an organized fashion so you're not affected by your emotions, but rather that you have professional management for the growth positions. And finally, when you do the financial plan, make conservative inflation assumptions. Even if inflation today may be low, if it's 1 or 2%, you should begin to assume that over the long term, inflation will probably be more like 3 or 4%, because if you assume that it's too low and you're wrong, then you're going to find that you're not able to make ends meet every month. The next topic is spending. You have to realize that retirement is a marathon. It's not a sprint. It's going to last a long, long time. And a lot of that time is going to be in your day. And what do you do? What I found as an investment advisor is that a lot of my clients who retire early they're still feeling pretty good. They want to go out and do things. They want to travel. They want to enjoy their hobbies. They do sports. They have kids they want to spend time with, and that means spending money. Watch out for that, because if you have all this extra time in your day and you end up going to the mall every day and picking up something here or there, all of a sudden you're going to find that your expenses go up a lot rather than down, which is what financial planners often like to see when people retire. Don't forget, there's no investment solution. You nor I, nor anyone out there who tells you that he can, especially, can control the economy and cannot control or predict the markets. But the thing that you can do is you can control your own personal economy. You can control your spending, and you can pretty much predict your needs. Now, I'm not talking about extraordinary expenses, or God forbid if there is some sort of health requirement that you have. However, even for those sorts of things you can plan. How? Make sure you have a well-funded emergency fund that includes minimum 3 months of living expenses, but maybe even up to 6 or 9 months worth of the expenses that you have, because an emergency is just that. It's something that surprises you, you weren't expecting it, and you need cash on hand. You need to be flexible if you're going to retire at any stage, but certainly early. Let's say things don't work out as you plan. Have an open mind about returning to work. Volunteer, do something, keep yourself active, because that solves the problem that I mentioned before about having too much time on your hands can often lead to spending a lot of money. Of course, because you have worked for decades, you now have a lot to give back to the community, and now is certainly the time. There's also nothing wrong with going and getting a post-retirement job. You can enjoy it, it gives you a social life, and you pick up the extra cash even if you don't need it. As far as the investments go, you got to begin thinking about how you've divided up your money. So I want to comment on one of the problems that people have, because this presentation is not about setting up your portfolio with stocks or bonds or anything like that. This is about thinking how you could retire early. And one of the tools that people often look at is they say, hey, I've got my house. I've got a big house. I've been saving for years. I paid off the mortgage. What can I do with it? Well, one opportunity that you have is you could downsize. Maybe you don't need to live in such a big house anymore, so you could sell it. Use the excess cash to invest in something that will produce income, and use the part of it to buy a new property. Or maybe even consider renting for the rest of your life, or moving into a retirement community where the costs, depending where you live, might actually be cheaper than maintaining the house that you have. Another way that people access the capital in their house, they access the equity in their house, is they do what's called a reverse mortgage. As the name suggests, instead of you're borrowing money from the bank, instead you go to the bank and say, listen, I've got my house and it's all paid off. I'd like you to pay me a monthly payment that I can live on to supplement my income, and my house will be the collateral. But you got to be careful, because a lot of times these reverse mortgages have interest rates that are higher than home loans. So whereas everyone else might be borrowing money on a regular mortgage, all of a sudden you're paying more, and the debt itself goes up very quickly because it compounds. The longer you have the money that the bank is giving you, and every month you're getting more and more money, whereas we always like to tell people to invest for the long term and let the interest and dividends reinvest so that you benefit from compound interest. The exact opposite here. Because you're not paying the bank, but rather they're giving you money, your loan is increasing at a compounded rate. Also, you should be aware that some pensions will be affected by how much income you're getting from a reverse mortgage. If someone lives with you in the house, a spouse, for example, or a roommate or a friend, and you die, which is the time at which reverse mortgages have to be paid back, what's going to happen to that person? Will he or she be able to stay in the house? And finally, let's say that interest rates that you lock in don't work out so well for you. If the interest rate gets to be very high, your income may not work out the way you expected. There are limits. The contracts on these things are huge when you get it from the bank, so you really need a lawyer to help you understand it. And finally, if you've been borrowing money against the equity in the house and you want to move, now you decide you want to sell, well, the bank is going to want their money back at that point. They're not going to wait until you die. And what could very well happen is you will have simply squeezed all the equity out of the house, and with nothing left, you will walk away with nothing from the house. Set up your portfolio using stocks and bonds and bank deposits. Use the basic investments, things that you've worked with before, that you understand the proportion that you have each one of these. That's worthy of a long discussion, and certainly of a personalized financial plan with a certified financial planner. But suffice it to say, don't start looking for anything new or radical, or when someone comes to you and says, hey, now that you're retired, why don't you put all your money into this unusual investment that you've never heard of that's going to pay you 20% a year? Because it's like my mother always said. Why do I quote my mother? It's because she was a financial planner for many years also. She and I were actually partners on Wall Street. And she always told me that if something looks too good to be true, it probably is. So it's a great idea to consider retiring early. But don't just think about retiring from your work. Think that you are retiring to do something new. And you have to decide how you're going to fill your day and how you are going to invest your money. If you need any help with this, or if you have any questions or comments, please be in touch with me. Just go to our website, www.profile-financial.com. Again, my name is Doug Goldstein. I'm a certified financial planner and an international investment advisor. I look forward to hearing from you.